ready to go. Okay, good. Welcome, everyone. I am Kelly Slott, owner and CEO of California Wealth Advisors and Kelly's Bull Market News. Many of you have found me on the radio show, so welcome. Appreciate you all being here. Tonight we have Mr. Saul Doherty that's going to speak with us about Class A apartments. That's what they specialize in doing, and we've done quite a lot of work with them over the years. They've done great. I'll let Saul go into his program. I'll introduce him in a minute. So we do have a lot of these seminars to educate you. We love educating people. So this is one way we do it. So people in Zoom, people in the room, we have more people coming in the room. So again, welcome to everyone. Glad to have you all here. So our next one is on April 21st. This is our Building Foundations for Financial Wealth series. I do 4 of these a year. It's Zoom only. So sorry, and the people in the room, you can't come to this one. You can do Zoom though from your home. This is on the 12 risks in retirement. So if you're either pre-retirement or in retirement, this will be perfect for you. We want to avoid as many risks as we can. So this is the next one on April 21st. Then we have another one on April 30th, and this is on commercial, industrial, residential real estate as well. So that's on April 30th. So sign up for that one. That's in person here in the room as well as Zoom. So you can do either one of those. And then just to go down the road a little further, we do have July 14th. This is my next Building Foundations for Financial Wealth series. This one's retirement planning versus retirement hoping. So that will be in July. And we have many more on the website. So go to CaliforniaWealthAdvisors.com, go to the website under the events tab and look there. We have our Carnival summer party, and I know everybody in the room is looking forward to that one. That's going to be a lot of fun. We don't do any presentations. It's just fun and party and great food and all of that. I also want to thank Connor tonight. Thank you so much for participating here and running the whole show. And Brian's down the hallway a little bit too. Thank you for doing all that you do. Really, really appreciate my staff. So valuable to, I know all of you in the room as well as the clients they talk to on the phone all the time. So thank you guys, really appreciate it. Okay, I'm gonna jump into some of my slides. So Connor, if you wanna take me over there. Perfect. Is it me now doing the slides? There we go. Okay, so me and Saul Doherty. Again, I'll introduce him in just a moment. So again, thank you Saul for coming tonight. We appreciate it. Okay, so again, many of you have found me on the radio show, KNX 1070. It plays on Saturday mornings. All of my radio shows are on my website. So CaliforniaWealthAdvisors.com. If you go to the radio tab, I have 5 years of radio shows on there. The most recent one's at the top. So if you can't catch us on Saturday morning, no problem. Just go to the website and the most recent show will be at the top there. I love the radio show. It's so fun to do. I don't do product specific at all on the radio show. It's really educational. What to do, what not to do, how to diversify. I have all sorts of subjects I cover. So it's a lot of fun. So please join us there if you can. And of course, I wrote a book, The Great Retirement Mystery, How to Avoid the 6 Biggest Blunders. This book is really for anyone, I would say age 20 to age 90, because there's blunders out there and I want you to avoid them. And I also talk about strategies to how I think about investing and how I can help a lot of folks. So The Great Retirement Mystery, How to Avoid the 6 Biggest Blunders. You can get that on Amazon. You can get it from our website as well. So I'm very proud of our book that we did. Okay, what are the key components to investing? And I know many of you have heard me talk about this, but this is oh so important for all of you. You need to have a plan. It needs to be specific to you. Don't do portfolio A, B, or C like a lot of wirehouses do, because that's not going to serve you. I want you to have a plan that's specific to you. So I also, while you have a plan, want you to have diversification in your portfolio. And again, this is what I see many times with 401ks, IRAs, pensions. They're all in the stock market. And there's nothing wrong with the stock market. However, a lot of times people come to me and they don't want to be 100% in the stock market, especially when they get into retirement, because why? There's risk involved. So I diversify people through my mass proprietary process. Markets, alternatives, safe money, MAS, mass proprietary process. I love doing that for people. It tends to bring comfort and peace of mind because you're not all in one place. You're not all in the stock market, because all of us really have seen the stock market go up and down, certainly this year, and that's not that fun. So here's a schematic of the mass proprietary process. So again, M is the market, stocks, bonds, and mutual funds. Again, it's red for a reason. It's going to go up and down. I use it for the liquidity we can get there, because if we buy a stock today, we can certainly sell it tomorrow. Might be gain, might be a loss, you never know. However, it is liquid. That's a good thing. I also do them for the income that we can create, the growth that we can create, or the income and growth we can create out of that. So M is great. I don't mind that. However, like I said, when most people get into retirement, they don't want to have that much risk anymore. Maybe some there, but maybe not all of it. So that's where we look at the alternative side. So that's real estate, that's private placements, it's oil and gas, it's even gold and silver. Those are investments that don't go up and down with the stock market. Now, Saul Doherty tonight will talk about Cottonwood, which is in the alternative side. So I love bringing specialists in to speak about that because a lot of clients just are unaware of the alternative side and how it can work. Because a lot of big wirehouses out there only do the M part, the stocks, bonds, and mutual funds. And that's fine. But again, there's more to investing than that. So real estate is a great place to go. Private placements, like I said, oil and gas, we can get write-off programs in there as well. So if you sell your business and you need some write-offs because you have a big gain, or you sell your primary place of residence, we can do some write-off programs for you in the oil and gas field. We can also create tax advantage income in the real estate, private placement, and oil and gas realm as well. So we do that for the growth, for the income, and being an alternative to the stock market. So again, it doesn't go up and down with the stock market. That's a good thing. A bad thing, or maybe something that's more of a challenge in the A side, is it's not liquid. It's just like buying a house or buying this building we're in. You don't buy it today and sell it tomorrow. You buy it and you hold it and you manage it and you collect the rents and then you sell it eventually, hopefully for a profit. So that's a good thing about that side of the market too. And then S is safe money. So that's when you say, hey, Kelly, I just don't want any risk. I want to have something that's insured, backed by an insurance company. I know my value is never going to go down. Maybe you tell me, hey, Kelly, I want to have income that's guaranteed for my life. I can't say that about the stock market. I can't say that about real estate either. I can say that about insured products. So annuities, life insurance, long-term care is a lot of times where we go for that. And I do have seminars I've recorded on my website. So by all means, if you're interested in that, go there and you can learn a little bit more about that. I like to do a mix of things here because I don't like all eggs in one basket. I don't know which section here is going to perform better than another. My crystal ball in my office down the hallway doesn't always tell me what's going to be going up and down. So when I diversify you based on your needs, wants, and desire, your risk tolerance, your time frame, your income needs, all of that, then it, like I said earlier, does tend to bring comfort and peace of mind to people in my view. So by all means, if you haven't met with us and you haven't done this, call us and get yourself on our calendar because we can definitely walk you down that road. Okay, I am going to talk about our private client process because this is, Brian's going to help me here bring over the slide. So you need to have your whole financial portfolio looked at, in my view. You need to have a plan for all of your assets, not just your stock, bond, and mutual fund portfolio or your investment portfolio, as I mentioned, the massive proprietary process. You need to look at your whole portfolio. So how I do this, and I like to draw this out, is I position myself as your financial director. Can you see that? That's not very dark. Let's see if I can find a better one. See if this one's better. That one better?
Yes.
A little bit darker? Okay. So I position myself as your financial director. So again, you have more than just your stock, bond, and mutual fund or real estate portfolios. You have more than that. But let's draw this out for you. So here's your investment dollars in right there. So again, this is your financial house. Then you have your risk over here as part of your overall financial house. So what's risk? Well, are you paying too much in taxes? If you're paying too much in taxes, in my view, that's not good because when you send a check to the government, Chris, do you get a check back? Not usually. I mean, they're going to keep it, right? So let's make sure you're not paying too much in taxes. And like I said earlier, in the mass proprietary process, I do have alternative write-off programs that I can do for people that will really help them. So taxes is a risk, in my view, in your overall financial house. Social Security, when to take that, I think is very important. If you take it at the wrong time, you could be doing a big disservice to yourself because you're not getting the maximum amount out of that. 62 is the earliest you can take it. I don't usually recommend that because that's the lowest dollar amount you can get. 70 is the maximum age you can take Social Security. And sometimes we do look at that and say, well, do we want less at age 62 or more at age 70? So we need to definitely look at that. Your insurances, what kind of insurances do you have? Do you have enough umbrella policy for your homes and your real estate and your business? Do you have things titled correctly? That's a risk too. Titled, titled. If you don't have your real estate, your assets titled correctly, you might be able to be sued, and that's not good. You don't want to lose your assets through that. So there's a lot of risks here in your overall financial house, and you really need to address them. Then down here, we look at estate planning. So do you have trust? Do you have trust documents? Do you have correct trust documents? I had a client come to me recently, and he was a new client, and I said, do you have trust? And he said, yes, I do. And he's very well off. And he said, yes, I have a trust. I said, that's great. When's the last time you updated it? Because I like people to update them every couple of years. He said, well, I wrote it in the 1990s. I said, well, that was a long time ago. You didn't have children then. You didn't have grandchildren then. You might want to update your trust documents. So I do estate planning attorney seminar with my estate planning attorney and my tax CPA. I do those once or twice a year usually. So I work with a lot of estate planning attorneys and tax CPAs as well to make sure these trust documents are put together correctly and updated, like my client needed to have his updated. You need to have a power of attorney and a medical directive in your trust documents as well. I think that's imperative for you. If something should happen to you physically and you're in the hospital and nobody has a medical directive or a power of attorney over you, how are they going to take care of you in your hospital? You need to have these documents, very important. So that's estate planning. So make sure you have your estate planning taken care of here. And again, the titling is important too. If you have a lot of rental properties or a business, you need to have it titled correctly. Because again, if somebody hurts themselves on a rental property and it's in your individual name or yours and your wife's name, which I had a client, they had about 9 properties and it was in just their 2 names, the husband and wife's names. If somebody hurt themselves on one of their properties and sued them, they could sue them from not only that property, but all of their other 9 properties and other assets as well, because it's not titled correctly. It's not protected. So let's make sure your titling is correct here. Then we look at the vault here, or the family office, we call it. So that is where we put all of these documents together. Your trust documents, your medical directive, your powers of attorney. We actually put a lot of times copies of passports, if I could spell, passports. Driver's licenses go in here too. Any kind of important documents go in the vault, and that is so valuable. So if you get hurt or you pass away, your beneficiaries will know to come to us because we have all the relevant documents that you might need to take care of them or take care of the estate. So again, imperative that you do this. Is really kind of vital. Then you've got your investment dollars over here. Again, I talked about that with my master proprietary process, but it doesn't really matter if you have $1 million or $100 million. If you haven't taken care of all of these things, you could lose all of this pretty quickly by a lawsuit or going through probate, and that's not fun for your family to have to go through. So I do this to really protect your family and your assets. I did record this on my website. If you go to my website, californiawealthadvisors.com, on the first page there's 4 boxes, and one of them says private client process. By all means, click on there, and I go into more detail with this there. But I like to go through this because it differentiates us from any other financial firm out there. They just don't do all of this. And we do care about our clients, and we want to take care of you and make sure you have the correct documents that you really need to protect you and your loved ones. So very good to do this. Okay, Brian, you can take that back. Thank you so much. Okay, let me bring up Mr. Saul Doherty. Saul Doherty is the Senior Vice President of Capital Markets Southwest, the distribution arm for Cottonwood Communities.
Thank you.
Come on in. Here. Well, no, not yet.
Not yet?
I'm not.
Oh, sorry, sir.
Saul brings 28 years of marketing and business development experience in the financial service industries, and he's been with Cottonwood for 19 years. Is that correct?
Close.
Pretty close. Okay. All right. And we love Saul. Saul has been doing seminars with us for a lot of years, that's for sure. And Saul and I are very dear friends, adore him. What you need to know about Saul is he does the best Christmas cards on the planet. And if he has time, maybe he can talk to you about them because they're just unique and creative and just.
I need to bring one of them so we can show them next time. Yeah.
His family do the most creative, wonderful Christmas cards. It's amazing.
Yeah. Thank you.
What was one of your favorites?
My favorite one was Game of Thrones.
Game of Thrones.
We all did the Game of Thrones ones. And the most recent one was the Tiger King. So
the Tiger King.
Yeah.
Oh, that's so funny. So funny. So good job, Saul.
Thank
you for coming.
Thank you.
So those of you in the room, if you have a question as we go, write it on the paper that's there next to you. We'll have Brian collect them. At the end, we will answer questions. Anybody online, if you have a question, please type it in. I've got Brian monitoring those. So we'll take questions at the end, I think, to let Saul get through his slides. And so again, thank you, Saul. Appreciate it.
Thank you, Kelly. As she said, we've worked together for many years. I've actually been working with Cottonwood for about 19 years. Been on with them full time for 13 years, actually 14-ish now, as we work through that. And I've been in the real estate industry for over 20 years. I've done a lot of things with the company. I've worked in a lot of different things. We did 17 years of estate planning and business succession before I went full time on the real estate side. And I will tell you, it's great to work with somebody like Kelly and California Wealth Advisors that really is having a holistic plan that's looking at everything in there. You know, we talked about alternatives that she offers, as well as the stock market and kind of more safe, secure things in there. A lot of people have actually access to alternatives. They just kind of do it on their own. When you buy a condo or you have private real estate and that type of stuff, you're getting into it. Some people may be able to get into other adventures on their own. The difference between that and what Kelly brings to the market and what I'm going to talk to you guys about today is we bring it to a scale of institutional level. And so, you know, to give you an example, we manage about $3.5 billion worth of real estate. I don't know if that slide was coming up. We manage about $3.5 billion worth of real estate.
If you want to do your slides, you need to do the downward one.
Oh, there we go. Thank you.
There you go.
We manage about $3.5 billion worth of real estate. These are apartment buildings that have 200-300 units in them, right? And so, you know, if you own an apartment and you're renting it out as an investment property and you miss 1 month's rent, that could be catastrophic to your year. Whereas, you know, when you work in multifamily where there's 200 and 300 units in it, we want 94% occupancy. I want turnover in there. And so it allows for a different type of growth in those alternative investments. I'm going to talk to you guys today about what Cottonwood brings to the table. We specialize in apartments. The word from my attorneys first, because everything has risk to it. But we opened our doors in 2004, right? We only do apartments. We call that multifamily, right? We managed about $3.5 billion of that. Today, that's about 15,000 apartment doors, okay? The executive team, which you guys will see them here in a second, they've been working together for a long time. What I think is really important is that when we work, and the way we structure things, we are vertically integrated. So we have apartments that we own and we operate. We have apartments we build. We have apartments we finance. But we also own the property management company. We own development companies that build them from the ground up. I have a company that's called, the REIT has a company called Residential Indemnity, where it's you know, if you don't want to get renter's insurance, you can indemnify yourself from hurting the building through us. And the difference between Cottonwood and many other private real estate groups out there is that the REIT owns that. Those are called the operating businesses, and that's vertical integration, right? But when those businesses make money, they're kind of the fees that get generated, they're owned by the REIT, so they're shared with our investors. So it really aligns us with our investors in everything we do. And we offer multiple ways to invest with Cottonwood. I'm going to focus today on our philosophy and what we invest in and our common stock that you'll see there's an opportunity to invest in. But there's other ways there I'll touch on here later that you guys may want to look at too. That's something you can sit down with Kelly on and really understand better. But aligning yourself with your investors means we make money together. And our intention is to do that long term. We've been around for working on 22 years now. We've been through multiple cycles of real estate. So, you know, earlier Kelly was talking about the stock market and real estate not being kind of in lockstep. They all have their own cycles to them, but they don't correlate to each other. And so that's why owning real estate and other alternative investments matches so well with that exposure to the stock and bond market, because one may be up while one's down. If we look back to 2022, where the stock market was down, real estate was up. In fact, my fund was up 17% in that year where the market was down 20. And so that non-correlation, almost opposite correlation, is really what you're looking for when you get through this. And as I said, our focus is only on apartments. This is my executive team on here. These guys have been here for 21 years. I think what I'd like to take away from this is that everybody here has been for a long time. We don't have people coming and going. This is a cohesive team of what we look at as best in class, right? Guys that have been doing this for a long time, ladies that have been doing this for a long time, and they are second to none. I will tell you that. As we look at past performance of our fund, it's not a guarantee for future results, but when we look at this kind of stuff, it shows you really that we've been able to provide growth and income. So we've had funds that done 11.7. We've had some that done in the 12s. We did a development fund that generated a 17. That's those. Each one of those has little different risk elements to them. But we've done a lot of different investments where people gave us money. We invested in real estate and we returned their money to them at a positive return. That's what you want to see, right? Is that we as a sponsor company are able to operate through multiple markets and provide you growth and income. And different types of investments will provide different ways that gets to. You know, the one on the bottom here that's 17%, that was we built 3 apartment buildings that had a more risk level to it. And you expect a little higher return with that, right? The ones where you're seeing 12s and 11s, those were stabilized assets with a little bit of blend of some of that stuff. But you had less risk in there and it got you to what you were looking for. For us, the model is Class A apartments, all right? We're happy to own different types of real estate, Bs, and stuff like that. And the difference between an A and B is typically the age that it is, where it's located. You know, an A class is something newer that's been built, typically more towards the downtown of a market that you're looking at. And we're looking for the growth markets of America, right? We're looking for really the secondary growth markets of America. If you look at my kind of list of where we own things, it's mostly the Sun Belt, but it's where you're seeing job and population growth. And I'll pinpoint this a little bit better in a second, but I think what we like to point out is that we don't just own apartments. We do have a segment where we loan to developers and get interest income back from that. We build apartment buildings from the ground up. Right now, it's about 6% of the portfolio. The debt side of it's about 13, and about 80% of it is still the operating apartments where there's bodies living in there, paying rents, you know, doing that stuff. Our target is this kind of Class A. You're getting somebody that's 24 to 40 years old, right? I mean, how many people in here know somebody renting an apartment? You know, the online people can't raise their hand, but it is across America. And every time I do one of these, I ask people who in here has lived in an apartment. And pretty much everybody can raise their hand. And my next question for you would be, you know, who had their rent go down? I personally never had that happen, right? And so we look at apartments. It's a stable in life. We can't outsource sleeping to another country. That's not happening. It's got to be here. And so supply for that, the quality of that all matters. Our focus right here, we have $2.6 billion in the fund. Earlier, you heard me say we manage about $3.5 billion. We're still managing assets for other institutional groups and other owners. The fund itself, this is called Cottonwood Communities, is $2.6 billion in total size, 48 different investments in there, about 12,500 thousand units, meaning apartment units, across all those levels. My average rent is about $1,500, so not much in California, right? But you get across the Sun Belt, and that's a more manageable thing. Now, we just acquired a $500 million portfolio from another group that we bought that were B assets. So it brought our average rent down a little bit, right? Brought our occupancy down a little bit, brought my leverage to a right level. We're going to fix those up. We're going to sell those off to somebody else, and we're going to buy Class A again. Because the goal is you can buy any piece of real estate for the right price, and it's a good piece of real estate. But you always want to cycle back to the high quality so that the next time there is a cycle change or there's something, you have a high quality asset that generates good income and is sellable in case you need it, right? And the truth is when you have good real estate, you hold on to it for as long as you can because it's going to provide great things to it. And then you adjust as market supply and things go through it. So looking at what our philosophy is here, right? These are kind of targeting, I kind of said all this stuff, but targeting major metropolitan areas. We want it resilient for employment sectors. We want to get the right renting demographics. And you want what we call infill sites, meaning like you can't build something right next to it and make it hard to rent to. So when we look at this, we're looking where the counties are growing, right? And if you look at this as a hard slide, but the darker the blue, okay, the more percentage growth you're seeing to that. And if you look at the yellow dots, which is where we own things, it's hovered right all over that. We look in the country and say, where is the major GDP growth, gross domestic product? I mean, where is more stuff coming from? Salt Lake City in Utah is one of the biggest growing segments of America. A lot of people don't know that, but that's where we have major centers. For full disclosure, that's where my home office is located. We know that market really well. It was super hard to buy into it, so we built into it. Okay. And that's part of the value of being an operator, a developer, and a financer is dependent upon where the opportunity is. We can get into those markets however makes the most sense. You can shift around how you're investing based on what was happening in the economy today. And to give you a really quick example, 2022, we had a major interest rate change. It caused the biggest correction in what we call commercial real estate. I don't care if it's apartments, industrial, shopping centers, or any one of those asset classes. It was the biggest correction we've seen since World War II. It made it hard to buy stabilized assets. So we did more of the lending, and we're able to get returns in that method and shift around how we were doing, but focused still on these same things of where we're seeing growth in the USA, where we're seeing demographics change. This slide up here talks about what are the types of jobs people have that work in your apartment, and how do they do during recessionary times? So kind of in orange on the left here is technical corporate focused jobs. To the right is the skilled, workforce labor we know and love. We've all either done it or have family members in it. And unfortunately, that job source tends to do less good, but the way to say that, not as well during our economic hardships. So we look at the 2000 dot-com bubble burst. We look at the '08 financial crisis. I look during COVID, and you can see these lines here are unemployment rates. So that means during the hardest times, people with that type of job got laid off sooner, had felt the recessionary times harder. The people with the more technical jobs, took a little more education to them, tended to be more resilient. And I like to joke and say during COVID, our tenants just flipped up a laptop and went to work, right? But that's the truth of it. If you focus on Class A, you attract a higher credit tenant. And so when you look at supplies across the US, and this is really what's going to drive things going forward. So the first one thing I just told you about was really, why do we like Class A? Well, it gets me a higher credit tenant. It costs me less to operate it. I generate higher rents, and it's more sellable during hard times if you ever needed liquidity, right? Here, what is going to drive things moving forward? And it's supply in the country. So this slide talks about how many houses and apartments, single family and apartments, did we deliver to go on the market ready to be either bought or leased up. Okay? Orange is apartments, the multifamily. Gray is single homes. And from 1968 to 2008, we provided about 1.5 million, 1,546,000 new homes and apartments every year. That is actually what we need in the country. Okay, for new household structure, people moving out of mom and dad's, buying their first place, renting their first place, moving out there. That's our need. Okay, from '08 to 2025, it's about 500,000 less. So that means over the last 17 years, we've been short 500,000 homes of what we needed on average. That's a big number. That's 8.5 million homes. Now, some of it caught up a little bit. Okay, as we looked at the development. So this slide is really important because it shows new deliveries, right? New things coming onto the market that we're going to have access to. And the fundamental thing of all economics is supply and demand. So we look in '08, the supply dropped off immensely. Why? Because people didn't have jobs. Felt like the world was ending. Financial institutions were blowing up. We had, commercial mortgage-backed loans blow up. And it felt really strong and bad. All the people developing stopped developing. Banks stopped lending to them. And so you see the supply drop off a cliff like that. It took us from '08 all the way through to 2022 before we really got back to where we were building again and supplying the country. Okay. Now you can see at the very end of this, there's a little drop off. I'm going to show you how that works. This next slide is new starts, meaning what developers started. And now this is focused only on apartments here. But from 2022 to 2025, we have 55% less new projects being started. That's huge. That's more than half new startups. Now, remember, we were talking about what we needed in the country was 1.5 million. We barely got back to that. And now that's dropped off. So this drop right here is going to create the same drop off you see in '08. You can already see that the orange slide there kind of drifting down. Economics 101, high demand, low supply, what happens? Values go up. In our world, rents go up. Okay? And so this is what's going to supply the next cycle of real estate. 2022 was a correction. 2008 was the first correction before that. 2020 was like a mini kind of fake one because we had COVID and you couldn't raise rents and all that kind of stuff. But the last two real estate cycles were '08 and 2022. They usually happen every 5 to 10 years. The last one was long, way longer than what people expected. But where we sit today, these are the economics of what's going on. And this slide talks about what I just talked about. This is called the commercial price index, right? And you're looking on the bottom at quarters and on the top at pricing that you're coming through there, right, on per square foot. 2008 was a really bad financial crisis. And that drop looks pretty big. But you follow it over to 2022, and I'm looking specifically at orange since it's apartments with what we deal with. That correction is way bigger. What I will point out to everybody in this slide is that the bottom of 2023 and 22 is higher than the top of 08. And what that tells you is, like everything, stay on the train, stay invested, don't panic. That's why you hire Kelly. That's why you hire groups like us. Because what we do different is take the emotion out of it. We follow rules. We follow academics that go with it. We know those industries really well. Now, I'm not saying you don't take a little off the top at the right times and rebalance things, but that shows you that long-term real estate in general is going to do well. And right now we have opportunity because we're at the bottom of a cycle. So for Cottonwood, I mentioned it before, we do three things. It's operating them, financing them, and building them, right? So here's the examples we look at. This is something we bought in 2017. It was built in 2015. It's new. It's got, pools, fitness centers, dog parks. We put what used to be, what was it called? Not WeWorks, but Regis-like centers in the inside the apartment buildings now. So if you've ever been to one of these things, they have clubhouses, usually with a pool table and all this fancy stuff, and nobody's in them. Well, my operating guy came along and said, as a 23-year-old son, what do I have to put in the apartment building to make you want to go in that space? He says, give me free Wi-Fi and a space to either game or work. So what we did was blew out all these things that were like they weren't being used, and we turned them into workspace. And now our tenants are down there working and gaming and doing things. Put 1,000 gigs of free Wi-Fi. Well, we don't make money on that, but it turns out if you know 3 people in your building, you're 85% more likely to renew your lease. And so we other than the pool, we've created this dead space into this place where people meet people. And by the way, it works out pretty good because everybody worked from home for a little while. And if you know and have done that, after a while, your cat, dog, girlfriend, boyfriend, husband, wife might drive you insane. You need to get out of that space for a little bit. And we created that in this community. And so this is what we do. We get these nice ones, we kind of make it a little more amenable, and you run with this, and we get great rents. This is an example of something we built. This is called Park Avenue. It's in Salt Lake City. It's a really nice Class A place. I mean, this thing is beautiful. It's got our apartment co-work space. It's got these pools. It's in the best growing market in the U.S., and it's right outside this real wilderness area called Sugar House. It's a huge park they have there. Walkability to restaurants and all kinds of fun stuff that are in there. But this is what we build, Class A. And then here's an example of what we financed. This is Hollywood, Florida. We loaned a developer $10 million. We got a 14.5% yield back. Those used to be like 11 to 13s, but since banks aren't lending, we're getting a higher yield. We're getting anywhere from 14 to 16, and we've done a bunch of these. These are all the deals that we funded that went full cycle and we got our money back. There's only one ever we had to take over. It's that one right there, 805 Riverfront, Sacramento. And the developer got a little over his skis on some of those other developments. In 2023, banks were demanding your reserve capital. He couldn't do it. We are not the bank. We would be second in line typically. But the way we structure these, we are first in line because I'm a developer, right? I mean the whole company. So we were able to take it over, finish the development, which was pretty much done, lease it up, and get it stabilized. And that's the ability and the things you do as a sponsor to be able to make lemonade out of lemons, right? In fact, now that asset is doing fantastically, and we're creating other opportunity for investors to be able to 1031 into it, right? So that's really our investment philosophy, is have those three things, be able to provide that, be vertically integrated into it, and aligned with our investors. Now let's look at a little bit of our historical returns and some of the affordability. So, this slide is just showing that apartments has really been one of the top performing asset classes in the market. It's typically the least volatile and the best hedge against inflation, though. Although industrial has been doing very well. How many people have ordered from Amazon today? Oh, I don't think you're all telling the truth. I did. And so that drop ship of stuff that you have coming in 24 hours is promoting the industrial space. right? That's really what gets through there. You saw that boom from nowhere to somewhere in the last 10 years because of all that drop ship that we do. And that's a great space to be in, but they're longer term lease with less growth in the rents, right? If I'm an apartment, I get to check my rents every year. And so we're always looking at how you hedge inflation. This slide talks about how multifamily has beaten inflation by 5.4% over history. So if inflation comes up and rents were going up, right? Like we saw in 2022, inflation was through the roof, 8%. I was getting, probably not great for everybody, but 10, 15% rent growth. We strive for 2.5 to 3. Rents go with inflation. And so apartments are this great hedge against inflation. What I really like about this right here is if you look at the dots, these are positive or negative years. From 1990 to 2025, we've only seen 5 years of negative returns in apartments. And after that, we saw a decade or more of really strong growth. And we are right now sitting after one of our first drops and as things go. So we're about to look at a very long road of positive growth for apartments. One of the other things that drives this is generations today don't have the same lives that we had in the past, the generations had in the past. 2 out of the 3 people under the age of 35 are renters. The average new home buyer's age today, this year, is 40. That's up 2 years from last year at 38. That's crazy growth that you're seeing on the age doing there. And that's being driven because housing is so expensive. We just talked about this huge correction we saw in commercial real estate. Residential didn't have it because we had 2% mortgages, 3% mortgages. We'll never see that again. But it's all the people that bought a house and financed it, they can rent those. And so that's also creating less supply, right? Because the new home buyer can't get into it. Lifestyle, having kids later. It's more important to have a trip to Malaysia with a selfie than it is to own a home. And so all that drives to renting and what we provide. Okay. So Cottonwood and our returns. This is my fact sheet, which is a lot of numbers and can look a little scary. I look on the left-hand side, this that just talks about the yield that my fund, my common stock is going to drive. It's a 5.99 in an advisory account. So that's a gross number that doesn't include any fees. If you're looking at it, net of fees and stuff like that, it was somewhere around a 5.14. That's a good, strong return to it. My since inception number and my 5-year numbers are 7.8% and 7%. Okay, that's since 2018. Those are really strong numbers considering the correction we had. So this talks about my stock price. This shows we started out in $10 a share in 2018. It grew to $20.72, doubling, right? The distribution rate went from 50 cents a share to 68 cents a share, almost 40% growth. Now, since then, we've seen a correction of 2022. It's back down at 11.37. And what that screams to everybody, and I'm not going to sugarcoat, that was a big correction. That's the biggest correction we've seen since World War II, is the opportunity we have today. And the ability to get into these with a company that's been through multiple recessionary environments, has a history of growing its distribution rate, i.e. the distribution you're getting and the checks you're getting, and being able to maintain that growth. And for most people, when they look at real estate, it's give me my income, give me my rents, give me my checks. I'd like some growth with that, please, but at least make sure those checks keep coming. And that is something we have never missed a distribution, right? We trimmed it a smidge recently, but before that, we'd never done it. And what you want to see is that ability to do that through multiple recessionary environments. Today, we have opportunity. All right, so my fund today is structured in what we call an NAV REIT. It's something you buy it. I just told you guys the share price is 11.36. Okay, you get a distribution rate off of that, so a yield's coming out to you around 6%. All right, it'll change based off the price on there, not for you once you buy in, but based off of the current new people that are buying into it. We have a third-party group that does an appraisal of all of our real estate and our businesses every month and strikes our price for us. Right, so it's out of my hands. It's true third-party, appraisals to that. It's not based off the stock market and what somebody wants to pay for it. It's based off the appraised value of the rents we're getting for it and the cap rates that are in the market. So interest rates do affect cap rates, right? But usually you can handle that if it's small adjustments. It's only because in 2022, the Fed changed rates from 0 to 5 in like 6 months, 16 months, or some crazy short time. It's faster than anybody's ever seen in the history of the Fed. But it also has liquidity to it. So earlier, Kelly talked about not having liquidity in this market. It's not the same liquidity as the stock market. It's quasi-liquidity. As long as 2%, no more than 2% of the whole fund looks to liquidate every month, if you want to liquidate, you can get all your money out. If we hit that cap, then we prorate everybody, give them as much as we can, and then we go to the next month. I'm proud to say we've never hit that moment. So we've never had to hit the cap on there. We've honored every redemption anybody's ever asked for. It's not to say it can't happen there, but it's private real estate, right? It's not super, we try to keep money on hand so you can get to it, but you'd have to sell an asset, which is what you have to do sometimes. We are in a spot where we've been super fortunate. A lot of it's how we manage it and our performance that's gone with that. But you do have quasi liquidity in a common stock. So for us, we're 2.6 billion today. I'm about to announce another acquisition. It's probably going to take us over 3 billion. Right? I know that our deal's already been done. We'll have that stuff out here shortly. We're super excited about that. That's all going to add to the property management fees that the fund receives, the growth that we're seeing on there. All the drivers that we just talked about lack of supply is going to push towards this. And we have a very bright future for the next 3, 5, 7, 10 years in apartments. All right. I talked to you about common stock today. It's something where you have growth in income, you've got quasi liquidity, you got value risks in there, right? I don't know what's going to for sure happen tomorrow. There are theoretical possibilities that something happens and the market comes down. You have to be willing to take that risk. We do offer other ways to invest. We have preferred stocks open to accredited investors. It's something where if you wanted to get into real estate but have a little risk mitigation, talk to Kelly. Sit down with Kelly, understand what your goals are. She'll tell you whether or not you can get into one of those. They are doing exactly what they're supposed to do, which is provide income without fluctuation of value. They've all been performing well. In fact, we've turned over. So in preferred equity, you get income and the value doesn't fluctuate. And then at the end of the term, you either get your money back or it comes into the REIT. There's two different kinds that go like that. We've turned over $300 million of the debt kind that you just get your money back over the years. We've got a really strong history of doing that. We're providing the ability to be able to do 1031 exchanges into real estate. So if you own private real estate today, if you own apartments or houses or duplexes or whatever it may be that's an investment piece of real estate, even if it's industrial or whatever, and you don't want to be that landlord anymore, Kelly has solutions for you to get an exit strategy where you don't have to be that landlord. You can still preserve your capital gains, right, without paying taxes on it, preserve the ability to get tax advantaged income, and hold on to that till the end of your time where your kids and your heirs get a step up in cost basis. We even offer something called the 721 option where you can sell out of that investment real estate, go into a single asset, and ideally years later, a couple of years later, the REIT buys it and you wind up in the REIT instead of a single asset. But understanding whether or not you want to be a landlord and get out of that business and be passive, enjoy your retirement, get checks, run through that type of stuff, and be tax efficient, exactly what Kelly was talking about earlier, that's where you want to sit down and plan for that. You want to plan your exit strategy. Many people don't do that. We do it specifically to apartments. We've done it really, really well for the last 22 years, and I'm proud to work for this company. So with that, I'll see if you guys have any questions.
All right, we have questions. Do you want to make this? Thank you, Saul.
Yep.
That was fabulous. Okay. What should we expect moving forward with real estate?
Yeah, I think specifically with real apartments and all real estate, you're going to see back to kind of the norm. So, the last kind of 12 years were this hyper cycle of real estate. I mean, we saw a doubling at one point of real estate. I think you're going to come back to the norms of seeing, I think my fund will do somewhere between an 8, 10, maybe as high as a 12% annualized return. We had seen much higher than that in the last cycle, but I think things are going to be back to growing based off rent growth. We might see a little bit of dropping of interest rates, but I don't see that really soon in the short term for long term. And so you're going to see more reasonable real estate growth, which I think is a great place to be.
Perfect. What is your yield?
So we each investment that you do is a little bit different, but on the common stock today, the institutional share, which would go under advisory, is at 6%.
And is that any of that tax advantage?
Great question. Yeah. So the greatest thing about real estate is that we depreciate the value of the real estate itself, and you can shelter the income. To date, all my income has been sheltered as it came out. Last year, we had one exception where we sold some assets and shifted around how we invest. It came out as capital gains rather than ordinary income. But typically, we think people will get at least 80% of the income sheltered, meaning it looks like we're returning your investment to you, reduces your cost basis. And then if or when you sell it, you pick it up as a capital gains tax. If you never sell it and you perish, your kids get a step up in cost basis, or your heirs, whoever that is, and then you avoid that tax.
What is the minimum?
For the common stock, it's $2,500, so very low.
Very low.
Yeah, other investments are up of $25,000.
And how long of a hold should we expect?
Great question. I think all real estate should be looked at as a long-term investment. The common stock, you have to hold it for a year in order to liquidate without like a 5% penalty. But we would want you to go into an investment that's with a longer-term investment horizon, probably at least 5 years, being willing to not need that money, that principal. We have ability to access it in case life changes, which we all know does. But you want to have that long-term expectation of, I'm good with the income. If I don't need it, I can reinvest it. And if I needed to tap principal, I could, but I at least want a 5-year time horizon.
Yeah, when I make recommendations to clients, I always say I do 2-year, 5-year, 10-year recommendations. I don't do 1-month ones. So you've got to let it go its cycle, right? And we don't know what real estate necessarily is going to do. We do know that there's need for apartments and all of that, which is great. So yeah. Thank you, Saul.
I appreciate it.
Appreciate you coming.
Thank you. Thanks, everybody.
Thanks, everybody. Here. Thank you, Connor and Brian. Really appreciate you guys. We'll see you at the next one on April 21st. April 21st. Okay, we'll see you then. Thank you, everybody.
All right, thank you.